We can explain to you everything that's happening in the economy right now with only one candlestick. Let's not save the surprise. We're talking about the 10-1 US Treasury spread. And what we're going to do is show you exactly why this is so relevant and why it shows us exactly what's going on in the economy. Let's set this up. The Fed's coming, and they're going to cut rates soon, most likely September. The Fed funds futures now predict a 100% chance the Federal Reserve will cut rates in the next meeting in September. That rose significantly after the Federal Reserve's meeting yesterday. Now, the futures are expecting an aggressive Fed, not only to cut rates once. We're going to see in a moment exactly how aggressive the futures market thinks the Fed's going to be. This is the daily change. Now, this is today, the day after the Federal Reserve meeting. Let's take a look at the September meeting. Now, the odds that will only be a quarter point lower at the 5 to 525 range, that went down by 17%. What rose by 17% is that the Fed funds will actually be half a point lower at 475 to 5. Now, the majority of us and the Fed funds futures still predict we're only going to go down by a quarter point, but the money is moving more towards the 50 basis point cut category. In November, the odds that will only be a quarter point lower declined by 29%. That will be at the 450 to 475 range. That went up by 25%. They're expecting November a very aggressive Federal Reserve. In December, the odds that will be only half a point lower at 475 to 5, that declined by 29%. The fact that we'll be at the 425 to 450 range, that increased by 28%. See, the Fed funds futures are expecting a very aggressive Federal Reserve over the next 6 months or so. And in January, the chances that Fed futures, or the Federal Reserve interest rates, we should say, will be the 450 to 475 level, that declined. We're actually expecting much deeper rate cuts by January of next year. Well, this is where we stand right now. On the left-hand side, the blue bar represents a quarter point cut. That's what the majority of us are expecting in September, a quarter point cut. Most of us are expecting half a point cut by November, 3/4 of a point cut, 450 to 475 in December, and then a full percentage point cut by January of next year. That's where the Fed funds futures put us right now. Well, this is the Fed meeting calendar. September 17th and 18th, that's when we're expecting our first interest rate cut. We have November 6th and 7th for the next meeting, December 17th and 18th after that. However, there's a curveball. On November 5th, we have a U.S. election. Of course, the Federal Reserve is supposed to be completely independent of politics, but nothing really these days is. And there's a lot written about it. Fed Chair Jerome Powell faces precarious balancing act amid criticism from Republicans and Democrats who claim he gave in to bullying. And whatever he chooses, someone's going to say it's the wrong choice. Somebody else will say it's the right choice. Now, it's a factor to take into consideration. What we've just seen is the Fed funds futures that are watching the economy and the economic reports. They're expecting a very aggressive Fed. What do you think? Is the Federal Reserve really that independent? Are they going to follow the futures expectations? Now, in orange, 10-1 spread. In blue, that's the 1-year bond. In white, this is the 10-year bond. It's something we've been watching for quite a while. Now, the 1-year bond moves it's most closely correlated to interest rates. Short-term yields act that way. The 10-year bond is more closely correlated to the long-term expectations of our economic growth or lack thereof. So again, 1-year bond moves where we think the Federal Reserve is going to go. 10-year bond is expecting economic change over the long term. Well, going back to our chart that reveals everything, the orange bars show us the inversion, the fact that the 10-year bond is still below the 1-year, but notice it's heading lower. Now, the inversion deepens as the 10-year declines more rapidly than the 1-year. Well, what is this telling us? It's telling us that the expectation that the economy is declining is moving faster than the expectation the Federal Reserve is going to cut rates. That's kind of scary because we just saw the Fed funds futures are expecting a very aggressive Federal Reserve. Well, despite that, the 10-year bond, the white line, is going down even faster. In other words, what the market is telling us is that the market is telling us it's expecting the economy to decline faster than interest rates are. That's not a good position to be in. The 10 years accelerating lower as economic data declines. This is an example. The JOLTS report, the job openings report, it was released the other day. This is in thousands. So we're talking about 8.184 million. Now, this is one of the lowest numbers, actually, the second lowest number we've seen in quite a while. Job openings are on the decline. These are the JOLTS hires. These are the number of people that are actually being hired. That number was not so good either. 5.34 million. That's in thousands again, 341 million. Now, let's compare, and this is kind of interesting. Let's compare the job openings divided by the hires. Obviously, we want to see a lot of openings, but we also want to see those openings that will be absorbed by hires. We want to see companies fill those positions. For those of you in the job market, this should make a lot of sense. Right now, we have openings that represent 153% of the hires. So for every person that's hired, there's 153%, 1.5% or so more openings. Is that a good number? Well, let's take a look at 2009 in red. That's the S&P 500. We just put that there so it's a reminder of how the economy transformed in 2008. 7 was very strong. 8, it started to waver. And then 9, late 8, early '09, things really fell apart. Well, notice the blue bars. That represents the openings divided by hires. The amount of openings are out there divided by the amount of people that were hired. Well, in early '08, when the economy was still quite strong, we saw a level of 91%. There were 91% openings for every hire. That declined down to 67% at the lows of the financial crash. Now, remember, where are we now? We're at 150%. So, shouldn't that be a lot better? It feels like we're a lot better now because there's more openings out there. But then again, you could interpret the other way. You could say there's a lot of openings out there, but maybe, there's a lot of openings out there, but just people aren't being hired. Maybe they're not applying. Maybe the salaries aren't good enough, especially with inflation. Well, here's the answer. This is a labor force participation rate. This counts the amount of people actually in the labor force. Right now, that's 62.6%. By the way, tomorrow, Friday, we're going to get more data on this labor force participation rate. 62.6%. Is that a good number? We'll go back to 2008, 2009. We're at 65.7% at the lows. What is this telling us? Left-hand side, that's present day. 62.6% labor force participation rate. In the depths of the 2008-09 recession, we're at 65.7. So even in the worst days of that economy, the percentage of people out there working was better than it is now. Put some perspective in the job openings versus hires. It's not the fact of the matter is it's not a result necessarily that there's not a lot of jobs out there. There are 150% job openings versus hires right now compared to around 91% during the '08 crash. So there's job openings out there, but for whatever reason, and I'm sure that you're experiencing this as well, these jobs aren't being filled. Are the jobs real? Well, that's a different discussion as well. Now we have some other numbers. This is ADP payroll. These are for all jobs, all employment numbers. And it declined on a year-over-year basis down to 1.4%. That is the lowest level we've seen. Well, this goes back to 22 and certainly a lot further back than that. That's not good either. And going to the bond market, we can see every line represents a different maturity from the 3-month all the way to the 30-year. The point in this chart is that all yields are declining. Yields tend to move in the same direction as stocks. Stocks certainly have been wavering lately, especially today. Also in the anticipation of lower interest rates, declining economic conditions, it's no surprise. but that's not helpful. What is helpful is to go back to our original premise, the 10-1 spread. It's declining because a 10-year is going down faster than the 1 year. Well, let's go back in time to 2007, 8, and 9. The gray background chart, that's the Fed funds future, or the Fed funds, that's the interest rates. We can see like a staircase going lower. In green, blue line, that's the 1 year bond. In red, that's the 10-year on the left-hand side. The 1 year was actually above the 10-year. That was the end of our inverted bond markets. But this is the point here. Notice in blue, that's the 1 year bond, how it correlated so closely with interest rates declining. The 10-year bond also declined in the anticipation economic conditions were worsening. But what we're not seeing now is this. The 1 year bond was moving down as interest rates were chugging lower. Well, of course, we haven't cut rates yet. But if you're looking at the 1 year bond right now, it doesn't really look like for some reason a 1 year bond is expecting maybe as aggressive of a Federal Reserve as what the Fed funds futures tell us. Going again back to our original premise, yeah, the 1 year bond is declining, all maturities are declining, but not as fast as a 10 year. The 10 years moving down quite a bit faster, and we can see proof of this as a 10-1 spread declines more rapidly as well. And again, the premise of all this is telling us that while Federal Reserve interest rates, the expectation is that they will decline, the economy is moving faster. And this is all hinged around economic data. Speaking of which, what's next? Well, tomorrow, non-farm payrolls, huge number, of course. We have to see if that is as bad as the ADP and JOLTS numbers that we just took a look at. Next week, we don't have a lot in terms of economic data, but we do have a lot of Fed speakers, and they're leaving us all in the hands of earnings season. And this is a little bit of a scary premise because it's not one big number like the CPI or PPI, but rather a lot of different companies reporting a lot of different earnings, each one with their own message about the economy. Certainly, that's a recipe for some volatility, to say the least. But with that said, the homework, we want to take a look at the 1 year and the 10 year and the inversion and see if that continues to decline. If you see the 10 year move down faster than the 1 year, that's the trend right now. If that continues, well, that tells us that we're expecting the economy to decline faster than the Federal Reserve will cut interest rates. And logically so, because the Federal Reserve, maybe by political pressures, maybe they can't be as aggressive as they would like. We hope this has been helpful. We look forward to seeing you back soon.